Higher interest rates mean higher borrowing costs. Hence, the central bank's move to raise policy rates will make borrowing money for housing, auto, and businesses more expensive in the country. But according to the BSP, it has to make such moves to balance well the country's economy after the value of the peso against the U.S. dollar declines. Naomi Tubursha returns with this report.
Effective today, the policy rate of the Central Bank of the Philippines is up by 25 basis points. This will mean a higher interest rates for ordinary Filipinos availing of housing, auto, and other business loans. This will also increase the interest rates of commercial and industrial loans. This also means higher interest rates in the country's payment of its domestic loans and foreign debt. The central bank says this is a needed step to balance the Philippine economy, which is experiencing the effects of the increase in the value of dollar and the decline of the Philippine peso to 54 pesos per dollar. The value of the U.S. dollar is on the rise due to the U.S. Federal Reserve's move to raise interest rates to manage a 4-decade high inflation. This brought about in large by the war in Ukraine, which has affected global commodity supplies and prices. Through monetary tightening, the BSP prevents the continuous decline in the value of the Philippine peso, which could increase the value of products imported by the Philippines, such as oil.
The Monetary Board noted that upside risks continue to dominate the inflation outlook up to 2023, with pressures emanating from the potential impact of higher global non-oil prices, the continued shortage in domestic fish supply, as well as pending petitions for transport fare hikes due to elevated oil prices.
Likewise, the BSP increased its inflation forecast from 2 to 4% this year to 5%. Price growth is expected to decrease in 2023 and 2024.
Given these considerations, the Monetary Board believes that a follow-through increase in the policy rate enables the BSP to withdraw its stimulus measures while safeguarding macroeconomic stability amid rising global commodity prices and strong external headwinds to domestic economic growth.
In addition to monetary policies, the incoming administration may also introduce fiscal measures to respond to increasing prices such as subsidies, tariff reductions, and reduction on excise tax. For economist Michael Ricafort, above anything else, the main reason behind the global market disruption needs to be addressed.
For the meantime, hanggat nandiyan yung gera at nagdudulot pa rin siyang problema in terms of higher inflation, nagtataas pa rin ng interest rates ang mga central banks ng US, ibang developed countries, pati yung ibang bansa sa buong mundo, kasama rin doon yung ating bansa, para matugunan at i-control din yung parehong actual inflation pati inflation expectations.
The Philippine economy is expected to remain strong despite the increase of the dollar exchange rate and the price of commodities due to the strong GDP and employment rate of the country. Naomi Tubursha for The Nation.